Investors don't always have to buy a portfolio of actual stocks to diversify. The U.S. market has liquid equity ETFs and futures, as well as mutual funds that allow investors to benefit from equity returns. Investing in each is different. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, to discuss. Phil, what are the two things that traders often look at before they trade?
Yeah, I think the two big things they're going to look at is what it's going to cost to trade and how large a trade they can actually get done. And so what they're going to look at for costs typically is the difference between the bid and the offer, what's called the spread. And if that spread cost in percentage terms is very small, then it's going to be cheaper to trade than if that spread is 0.5% or 1% to cross and then cross back out when you're trying to sell the stock. So that's how costs will work out. With liquidity, they're probably going to look at how much dollars trade every day to work out how big they could actually trade without impacting the market and affecting the supply and demand themselves.
Are spread costs larger with stocks or with ETFs?
So mostly they're wider in the stocks, which is kind of interesting. And that just is a testament to how competitive the ETF market is, because ETFs are a basket of the stocks. But actually ETFs tend to trade much more competitively, much more liquidly. Some of the most popular ETFs in the market trade billions of dollars a day, and they have spreads that are less than 1 basis point, which is 1/100th of 1%.
Spreads data makes stocks look more expensive, but what about liquidity?
Yeah, so that's a good point. And that's one place that stocks have an edge. There's about $475 billion that stocks trade every single day. And that's a lot more than the total liquidity that trades in ETFs. And typically, even if you look at the basket of an ETF, the underlying stocks trade more than the ETFs. Even the most liquid ETFs trade every single day.
Are stocks equally liquid, and does that impact the indexes?
Yeah, it's another really good question. And the reality is not all stocks have equal amounts of liquidity. At a really basic level, a small cap stock has less cap and less shares to trade than a large cap stock. But even if you got the same market cap, large cap stocks and you compared them, one would probably trade more dollars per day than the other. And so if you're an index fund manager trying to buy a portfolio at index weights, actually can take longer than you'd think, given the market-wide amounts of liquidity.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.